Welcome to part 4 of the video titled KPMG Hedge Derivatives Book or Hedging Derivatives Book. Till part 3, we covered the mistakes of KPMG as far as the cash flow hedging is concerned. And I hope those who listened till part 3 got to know the stupidity by the KPMG. But before I move forward and before I present more facts, one thing I am always certain is that the big fours are not only corrupt, rather they their material which they are uploading on the social media, it is technically also not correct. I have studied enough material of the big fours which include KPMG, Deloitte, PwC and EY, and many times I have encountered big technical issues in these materials. If you are thinking that we are restricting ourselves towards KPMG, then you are mistaken. Because eventually we would be making a video covering Einstein and Young as well. And let me tell you, the mistake in the Einstein and Young is much more severe than you have in KPMG. So today I would like to bring in another in this part, which is part 4. I would be bringing another stupidity by KPMG. But before I showed you the guide, which is this KPMG guide, let me first take you a little bit back. There are 3 forms of hedging we have in the world. So whether you are Apple, you are Google, you are Amazon, or you are any other company, there are only 3 forms of hedging. Number 1 is the cash flow hedging, which covers the hedging of the cash flows of that company. Cash flow hedging can be done in deliverable market and can be done in the non-deliverable market. So if you are thinking that cash flow hedging is always done at non-deliverable market or deliverable market, then you are incorrect. It is the knowledge level of the treasurer that makes sure where to hedge the cash flow. Like in my case, I used to hedge my cash flows when I was a corporate treasurer in deliverable and non-deliverable market both. A very skillful treasurer understand how to hedge cash flow in the non-deliverable market. Today you will see no book, I repeat, no book published who can give you the knowledge how to hedge the cash flow in the non-deliverable market. But it is the ability of the corporate treasurer. But if you look at this book, which is by KPMG, you will never get to know about this. Rather, I will repeat the cash flow definition: a hedge of the exposure to the variability in the future cash flows of a recognized asset or liability or of a forecasted transaction that is attributable to a particular risk. What the hell is that? What is the risk? Where did KPMG mention the intercompany exposure? Where did KPMG mention you can hedge the cash flow in the non-deliverable market also? I challenge the partner of KPMG, rather anyone from KPMG who have made this booklet. If you really think you deserve to be a chartered accountant, you deserve to be from KPMG, then let me know Let us discuss your definition. But what is the bloody problem? The bloody problem is no one dare to challenge these big fours. End result, they always do what they love to do. As simple as that. Now I would be raising a very pertinent point on fair value hedging. But I'm not reading the definition of the fair value from this guide. I would be reading the definition in the later stages. What the hell is fair value? Like the word defined, fair value. You know, guys, the big companies like Amazon, Google, Microsoft, Facebook, Apple, Cognizant, Sapient, all these companies are having non-functional currency assets or non-functional currency liabilities in the local currency books. Now the name which I have mentioned, which is say Amazon, Google, Facebook, Microsoft, Apple, Amazon, and many, they have huge quantity of legal entities. Rather, it is important to say, pertinent to say that they hold legal entities almost everywhere in the world. Almost everywhere in the world. And majority of their legal entities have non-functional currency asset and liabilities. So before I move further, if you are thinking that the fair value hedging is all about hedging of the liability exposure, then you are highly mistaken. Because fair value hedging is about hedging of asset as well as liability exposure. But there is a big catch in the sea. And that catch is completely dependent on the corporate risk management policy. And the catch is, although very less quantity of companies, very less quantity do the fair value hedging. Because fair value hedging is highly technical in nature. You need have a model in place which would help you to get this done. And majority of the companies in India and outside India, they are running their treasury function as a cost center. Simple. So the end result is, do not expect the fair value. They are happy that the revaluation which happens at the end of the month, reported at the end of quarter, consistently losing up or eating up their PAT, which is known as profit after tax, and in turn impact EPS, which includes basic EPS, diluted EPS, and reported EPS, all three. But they never conduct the fair value hedging. So please do take a note that fair value hedging is conducted in both sides, which is asset side as well as the liability side. But a right treasurer is one who take the gross up positions. Now the gross up position means he adds the asset side to the liability side and take the total. While many corporate treasurers take the net position, which means asset minus liability, which to me is not the right approach because revaluation is going to happen together. Asset side revaluation and liability side revaluation. So net off is not justified. But if you read the definition of fair value, a hedge of the exposure to changes in the fair value of recognized asset or liability. A hedge of the exposure. What the hell is exposure? Which exposure are you talking it about? KPMG not mentioned that. The hedge of the exposure to changes in the fair value of a recognized asset and liability, or an unrecognized firm commitment that is attributable to a particular risk. What kind of risk? We don't know. Because fair value hedging is done to protect the revaluation risk. But did KPMG on page number and 8 mention that? No. KPMG forgot to mention that. But those who are reading these guides, they believe KPMG is intelligent. The hard reality, they are absolutely not. As we progress, more errors on the cards. In this part 5, I would take you how fair value can be hedged in your local country and how it can be hedged in the foreign currency, in the foreign country. Both are having their pros and cons. So I don't say that the first one is right or the later one is right. But having said that, it is always pertinent to hedge fair value in global treasury centers. Now, global treasury centers means Singapore, it includes Tokyo, includes Luxembourg, Frankfurt, London, and United States. I never find it pertinent if you are hedging the fair value in local country because premiums you will never get. The local regulator restrictions make it difficult to hedge the fair value. Accounting is definitely an issue in that regards. So I don't recommend anyone to hedge fair value in the local country. But this great book by a great big four known as KPMG forgot to mention this. Common sense, because people don't have ability to pinpoint, and KPMG is very clear. Why should we bother? See you in the part 5. We speak more about the fair value.